If you want to be a successful investor or successful trader, you have to have a system in place to handle the most important thing in investing. Part 1 of this video covers the most important thing and is conceptual in nature. If you're looking for market analysis, you may want to fast forward to this portion of the video. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In this video, we'll discuss what may be the most important thing in investing, a system to manage volatility. We'll use one example of a method used in the CCM market model. These methods apply to long-term investors, and they can also be adapted to somebody that's trading 10-minute charts. This is 1995. This is the S&P 500. We've basically drawn point-to-point lines, had a big bull market, a peak, massive bear market, bull market, bear market, bull market. And obviously, if this is the way the market worked, you basically made money every day, it would be very, very easy to stay in this market because you would continuously be getting positive feedback. And then when the market peaked in 2000, you would begin to get negative feedback on a continuous basis, and it would be easy to decide to book your profits and stand aside. Eventually the market would bottom and the process would reverse itself, and it would be very, very easy to get back in. Unfortunately, that's not how markets work. In the real world, we have to deal with volatility. And what happens is this volatility here, 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 and here, and here during a bull market shakes investors out of the market, preventing them from participating in these gains. During a bear market, these counter trend rallies keep investors in the market, allowing them to book the losses. What we need is a system that helps us stay with this trend and identify where the trend has changed here. Stay with this trend, identify a change, get reinvested, participate. In the next few charts, we'll cover one of numerous methods that we use in the CCM market model, and we use them on multiple time frames. Those of you who watch our videos on a regular basis know that these moving averages can help us smooth out this volatility. The most favorable and bullish look from a probabilistic perspective is when price, which is in black, is above the blue and the red moving averages. Blue is above red and the slopes are up. This is somewhat of a mixed look, where we have a negative slope and a bearish cross here. This is what we call a full bore bearish look. We get the bearish cross, price is below both, and the slope of the 200-day rolls over. What this system does is it helps us discern between volatility to ignore, volatility to ignore, volatility to ignore for the most part, so I can stay with this trend, discern between that volatility and volatility that I have to respect that requires defensive action. You can see for the most part during this bull market, we maintained a bullish look where blue was above red, price was above. During the bear market, we never have a bullish moving average crossover. The slope of the 200-day in red stays negative during the whole bear market. And then here in late 2002, early 2003, we get the bullish moving average crossover here, blue back above red. The slope of the 200 turns up, price is above both, and it helps us participate in this bull market. In 2007, we get a clear bearish moving average crossover again, and the slope of the 200-day in red rolls over. This system helps us stay out of this market between October 2007 and March of 2009. In 2009, we get the red moving average, the 200-day turning up. We get a bullish moving average crossover, and we move back to a full bore bullish look similar to this period here. This bull market's been a lot more difficult with a lot more volatility, and that's why we use numerous methods and have redundancy to help us smooth out some of this volatility. We're looking at the same market now, and this is really what the model looks at when it uses the 50-day and the 200. It doesn't really care about price and volatility. You can see it's relatively easy to stay with this trend for the most part, relatively easy to stay out. Helps you here, helps you again here. This is a bearish look. Again, a little bit more difficult here, but that's why you have redundancy in terms of your indicators and your time frames. At any point in time, as investors or even traders, because you can take all of this down to shorter time frames, we should be able to handle two major cases. How will we handle case A, where stocks rise for another 3 years? And a rational response at any given time is, that's ridiculous, that could never happen. Well, markets can move a lot further than rational people believe. You can see there's a massive run up here in the S&P 500. And here in 1997 at point A, there's already talk of a bubble and PEs are extended. The market moved from point A to point B after the bubble talk and after PEs were extended. So if we asked ourselves the question, in 1997, how would we handle if stocks rose for another 3 years from this point here to this point here? The S&P 500 tacked on an additional 91%. An investor who had a system in place to discern between volatility to ignore and volatility respect at this point in 1997, their $500,000 from point A would have been worth $955,000 at point B. If you started with $1 million at point A, it would have been worth almost $2 million at point B. With central banks printing money all over the globe and excess liquidity in the system, at some point the music will most likely stop. Bull markets are inevitably followed by bear markets. So we have to be able to answer the question for case B as well. What happens if stocks drop 50% in the next 1 to 3 years? History tells us a 50% drop can occur. Point A1 and point A2. It was very, very painful to participate in the move to B1 and B2. After the tech bubble burst, the S&P 500 lost 51%. And when the housing and mortgage bubble burst, the S&P 500 dropped 58% between point A2 and B2. It's not a question of if the next bear market will come, but when. Let's say we have something in between these two bear markets and we lose 55% in the next bear market. If you started with $400,000 and you lost 55%, your $400,000 would be worth $180,000. If you started with $2 million and you lost 55%, it would be worth roughly $900,000 at the bear market low. Obviously, it's important for us to have a system in place to discern between volatility to ignore and volatility to respect. In our case, the answer to both questions is the CCM market model. There's no such thing as a perfect indicator, and thus the market model has indicator redundancy. We also look at multiple time frames to give you an idea of how it works. You can take all of this data and you can ask, where is the MACD histogram now? Is that result unique to a bull market or a bear market? If it's unique to a bull market, you add points to your system. If it's unique to a bear market, you subtract points. If it doesn't help us discern between the two, we make no change at all. We can take all of this data, and that's what the submodels do, take it and boil it down to one score, and then we can compare that to historical scores and answer the question, is the present market profile similar to bullish conditions or bearish conditions? We can also understand when a market's profile is improving or deteriorating and adjust our allocation accordingly. The model basically listens to the market. If you look at the previous charts, there was no need to forecast anything. If we paid attention, monitored it, and tracked it, and converted it, the market will guide us to a proper allocation as it did in 2000 and 2007. We look at hard, unbiased, and binary evidence. The concepts also apply on shorter time frames. We looked at bull and bear markets. If we were looking at a daily chart, we can make the same argument for rallies versus corrections, and the market model does pare back risk during corrections. Another example of indicator redundancy. This is another one of the sub-models that feeds into the master market model using data from daily, weekly, and monthly charts. The indicator redundancy helps us reduce the severity of inevitable drawdowns and smooth out returns over time. The thought process of a market profile is if the market is improving, not all of these indicators will catch it or handle a rally properly, but the odds say a high percentage of them will, which speaks to a market profile and risk reward. The master market model also has model redundancy, where 5 separate sub-models recommend allocations, and we use that for the master allocation, allocating between growth assets such as stocks and conservative assets such as bonds. The rationale is if we're using different methods on different time frames, some of these sub-models will handle certain situations better than others, again helping us reduce drawdowns and smooth out returns over time. The concept of using a 50-day and a 200-day moving average is a well-known and widely accepted concept. The distinction here is we've taken these well-known and widely accepted concepts and converted them into a system that we can monitor in an unbiased way and convert into an allocation. Here are some screenshots of the sub-models that feed into the master market model. You can see some of the questions we ask. Is price above the 200-day? Is it above the 50-day? Is the 50-day above the 200-day? The slopes, all of the things that we just looked at in that long-term chart. If the answer is yes, it's a 1. If the answer is no, it's a 0. None of our personal bias can creep into that answer. The sub-models give us an indication of what the present-day market profile looks like. Then the master market model takes the input from the sub-models, all between 0 and 100, and compares the present-day market profile to past market profiles and recommends an allocation, a prudent allocation, between risk assets such as stocks and conservative assets such as bonds. We're now entering part 2 of the video, where we take the concepts discussed in part 1 and apply them to the markets in December of 2013. We'll look at the year 2000 and 2007 and compare them to 2013, and we'll also cover the following bullets and charts. Now we'll take these concepts of observable evidence and bring them forward to December of 2013. This looks very noisy. The concepts are very, very easy to understand. We'll look at things in isolation. Easy to follow. This is the year 2000 zoomed in, the 50-day in blue, the 200-day in red, and now we're zooming into the peak in October of 2007. You can see here the stock market consolidated and went sideways for 8 months prior to bad things happening. In the present day, if we go back 8 months and it were similar to this, the S&P 500 would be at 1540. This is an unsure, unstable market with bullish conviction roughly even with bearish conviction. Not the case here. Bullish conviction has clearly been ruling the day. There's another 5-month consolidation point to point. The stock market made no progress over this 5-month period in the year 2000 prior to this pain. Again, the last 5 months here, if that were the case and the present day were similar to this period here, the S&P 500 would be at 1680. You can also see another warning was the 50-day moving average in blue came down and kissed and touched the 200-day. If you compare that to the present day, they're still very, very far apart. 50-day here in blue, 200-day here in red. This tells you the present day trend is much, much stronger than this consolidation period here or even this point here. We can also look at slopes. They tell us a lot about conviction and trends. The 50-day moving average is used to help us discern the health and sustainability of an intermediate term trend. Notice prior to problems coming here in the year 2000, the slope of the 50-day is negative and clearly rolling over, and then we get the bearish cross as well. This is what's known as a death cross, blue below red, 50 below the 200-day. Let's compare all of this to the present day. Look at the slope of the 50 in the present day. The slope of this black line looks nothing like the slope of this black line. The slope of the 200-day, as the bear market kicked off, here's your slope of your 200-day. Here's the slope of the 200-day in the present day. Everything I just said applies to the peak in 2007 as well. The stock market went nowhere and consolidated for 7 months, waving yellow flags before the peak here and before bad things started to happen in 2008. If the present day were similar to this consolidation period, the stock market would be back here, would have made no progress over 7 months. In the present day in 2013, we'd be sitting at roughly 1640. Here's your slope of your 50-day. It had been down recently. We really don't have anything that looks like that telling us that the present day trend is much, much stronger in 2013 than it was here in 2007 and in early 2008. Same thing holds for the slope of the 200-day. Somewhat flat looking here, and then it rolls over. The pink line shows the slope. Compare these pink lines in 2007 and 2008 to the present day. The longer term trend in the present day is much, much stronger. We recently did have a consolidation period. It's been a little tough sledding here in the past 5 months here. The stock market really went nowhere from here to here, and it went nowhere from here to here. In October, when we recently had the low on October 9 and 10 of this year, if this box and this resolution came out in a bearish manner, we could have moved in the other direction. We have a bullish resolution that just took place in mid to early October of this year. It's possible we might come back and retest this box. When will we morph into something like this? Have no idea. We don't need to know. We just need to pay attention. If trouble brews, the math says that changes will take place in the 50-day, the 200-day, and in price. Regular viewers know that the CCM market model tracks weekly momentum. That's one of the binary indicators or questions that we answer. When the market's in overbought territory, good things tend to happen. When we drop out of overbought, bad things tend to happen following. Drop out, proper way to say it is the probability of bad things happening increases. We see some weakness here, hasn't dropped out yet. Same exact concepts here. The market model As you know, tracks numerous indicators. One of them is weekly momentum. And unlike the NASDAQ, you can see momentum did drop out of overbought territory. This is some of the observable deterioration we've been tweeting about on Twitter. And it's one of the reasons why we reduced our exposure to equities 3 times in an incremental manner. The market needs to prove it to us from here and start improving rather than deteriorating. We'll keep an open mind about what happens next week and adjust accordingly. The market model monitors market profiles, which speaks to probabilities. This is the NYSE Composite Index, a broad index of stocks. You can see when we bought the October low here, the observable evidence began to improve. This is a bullish trend change. Step 1, you have to break a trend line. Step 2, you have to make a higher low, and it gets confirmed when you make a higher high. You can see after the trend change was confirmed, stocks did well. Now the observable evidence has shifted in the other direction. This is some of the reasons, again, why we lightened up a little bit. When you reduce risk, it doesn't mean bearish, it means less bullish. The profile has deteriorated. Now we have a broken trend line here. We have a discernible and observable lower high, and now we have a discernible and observable lower low. As long as the market continues to deteriorate, the market model will continue to move away in an incremental manner. If the market rights itself, we're happy to redeploy that cash as we did here in early to mid-October. This is a daily chart of the S&P 500, and this chart is as of the close on Friday, December 13th. Just some slight deterioration, observable evidence. You can see after the October low, price stayed above the purple moving average. We never crossed below it until recently. This is a discernible change. During this whole move here, the slope is positive on the moving average. Not the case anymore. A discernible change indicative of a weakening trend. Nothing to panic about, but we've seen enough observable evidence to take a step away from risk. The lower low we just talked about. We just talked about the slope rolling over. Here's an example of the slope rolling over. Bad things happened after. Here you get a negative slope. Bad things are happening. This moving average here is also used in the model. You can see when it flattens out here, the probability of bad things happening increases. Flattening out, probability of bad things happening. And as of Friday's close, it's flat. We'll adjust either way based upon what happens next week. The market model uses numerous risk-on, risk-off ratios or charts. Here we're looking at stocks, the S&P 500 SPY, relative to the aggregate bond market or the AGG ETF. This is what risk-on looks like, full bore bullish, full bore bearish. We have seen some observable changes. The answers to some of these questions now. Is price below the blue? The answer's yes. Is price above the red? It's not above, so it actually gets a no in the model there. We also have the slopes of the moving averages. The blue one is now down. So we do have some observable changes. The question is, will the market right itself as it did here, or will it morph into something more like this or this? The observable evidence will help us. You can see here there's observable evidence before bad things happen, and here's the S&P 500 above. Here's another example of some of the binary questions used in the model. This is a Bollinger Band here, the blue, the dotted blue. In the blue, the questions the model asks, is price above the center line, and is the slope of the center line up? You can see here the answers to those questions are no. In the year 2000 and early 2001, the odds of bad things happening increased. Here, the answer to both questions, price is above the center line and the slope is up. Good things happen. Price is below the center line and the slope is rolling over. Bad things happen. Bullish cross, bullish turn up, good things happen. Notice the changes are observable. We can see this here before this happens. We can see this here and this here before this happens. No indicator is perfect. That's why we have the indicator, time frame, and model redundancy. You can find more information about the market model and Shivako Capital on our website or via our Twitter feed, on Facebook, the CCM YouTube channel, or our daily blog, Short Takes. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.